Hello, I'm Dr. David Lewis. Today I'm going to talk to you about behavioral economics tools for managing market volatility. I'm going to give you an overview of behavioral economics and also talk about some of the behavioral economic factors that affect our financial decision making. These include overconfidence, illusion of control, representativeness, loss aversion, information overload, and I'll also talk about the say-do gap that can get in the way of implementing advice. Let's start with an overview of behavioral economics. Traditional economics, beginning with neoclassical economics and rational choice theory, developed into the new classical economics and rational expectations theory, but they all make fundamental and unrealistic assumptions about decision making that most people would admit do not reflect reality. It's assumed that people seek all available information, calculate costs and benefits of incentives, and make rational choices that maximize utility. And rational has a specific meaning here. It means that we're calculating, analytical, goal-oriented, consistent, and predictable. Now, we may sometimes behave that way, but the vast majority of our decisions are not actually made as if we're computers. Behavioral economics has shown that there's countless examples of behavior diverging from what traditional economics predicts while conforming to what behavioral economics predicts. For example, we're often overconfident. We exhibit myopic loss aversion, meaning we're short-sighted and try not to lose money and oftentimes make poor decisions because of that loss aversion. Think of sticking your money in a savings account or under your mattress rather than investing it. We exhibit an illusion of control, where we think we can affect events that are actually beyond our control. We also have representativeness, where we think the current conditions will continue indefinitely. We suffer from information overload. There's a limit to how much information we can absorb and think about. There's also an implementation gap, where we have the best of intentions but don't actually follow through on them. Think of joining a gym but never visiting. Those are the ones I'm going to talk about today in detail, but there's many, many more. In fact, there are hundreds that have been studied going back as far as the 1920s. And if you think about how that actually can be seen in the real world, there was a great study that was done in Canada very recently, where 74% of clients who received financial advice from their bank acted on it. But only 19% were very interested in receiving advice, and 26% they were not at all interested. And the survey also found that those people actually really needed advice, even though they might not have been interested. For example, only 39% were financially healthy, 12% were overextended, and 13% were stressed, while 36% were vulnerable. That said, again, only 19% said they were very interested in receiving advice. And if you think about the cost of not receiving advice, numerous studies have been done on the value of advice. Statistically, the average equities investor, their inclination to buy high and sell low costs them 2.02% annually in the 36-year period from 1984 to 2020. That's a significant cost. We have shown in research at the BEWorks Research Institute that if you change the manner in which advice is delivered, if you incorporate insights flowing from the fact that we know people have these biases and we know they actually don't make perfect decisions as if they were computers, if instead we adapt our advice to anticipate these biases and overcome them, there are better outcomes. Our research showed that incorporating behavioral economics insights into the delivery of advice increased the willingness to follow advice, as evidenced by a more optimal asset allocation. Clients also selected more diversified portfolios, and they achieved superior Sharpe ratios. They were more trusting, they exhibited higher satisfaction, and they expressed a higher intention to seek and follow advice in the future. Clearly, behavioral economics principles can improve client outcomes. I'm going to talk in much more detail about that for the remainder of this session, and give you some examples of what the biases are, as well as some simple tools for how to overcome them. So let's think about the brain for a moment. On the one side, we have the model where we're normatively optimal decisions and we dispassionately pursue self-interest and we make unbiased judgments and we effortlessly implement those rational decisions. That's a great ideal, but it's not actually reflective of reality. We have cognitive limitations. There's only so much information we can absorb and process. We have ill-defined desires and preferences. We're often not sure, think in the context of investing, we're often not sure what we really want. Do we really want higher return, or do we really want no risk, or do we want something in between? It's very difficult to determine exactly what we want, and it changes in time. And those judgments are influenced by emotions. You think about the weather as an example, has been shown to affect trading. But think about current events, geopolitical uncertainty. That negative emotion influences our judgment. Even if we try to be computers, but we can't help but think about it. And we're also subject to self-control and self-regulation problems. We know we should avoid buying high and selling low, and we know that we should try not to time the market. And we know that we shouldn't follow what everyone else is doing in the market. If everyone's buying meme stocks, that doesn't mean we should as well. But we also know that many people fall prey to those self-control and self-regulation problems. And the result is a permanent reduction in their financial well-being. Let's focus on 4 of the big factors affecting decision-making right now. One is overconfidence bias. People often overestimate their ability to invest. If you think about driving as a funny example, 94% of Americans believe that they're above average in terms of their driving skills. We know that's mathematically impossible. And yet, if you look at people's confidence in their ability to invest, their subjective confidence, what they think they know, typically exceeds their objective confidence or their objective knowledge, what they actually know. So thinking you know more than you actually do can be a problem. Another one is loss aversion bias. It's been shown that we tend to feel losses as twice as painful as the equivalent market gains. So for example, losing $10, we're twice as unhappy as we would be happy by gaining $10. And that causes us to tend to avoid risks, even though we know that risk and return are related. There's also illusion of control bias. People tend to believe that they have control over random events or events over which they're powerless. Think of wearing your lucky jersey and thinking it'll help your team win. That's a funny example, but people also tend to think that they can determine exactly the right time to make a trade and exactly the right time to make a purchase and exactly the right time to sell. So during periods of volatility, people tend to liquidate their portfolios, put it in a savings account, and think they know exactly when to then reinvest in the market. We all know that that's simply unrealistic. And then there's representativeness bias. We tend to believe that current conditions are representative of future conditions. I can recall working on Wall Street during the global financial crisis and hearing people say that the S&P 500 was going to zero. We know that didn't happen, but the opposite can also happen. When the markets are frothy and bullish, people think it'll go on forever, and yet we know that it doesn't. Inevitably, there's a correction. So let's talk about overconfidence bias in more detail. As an example, one aspect is illusory explanatory depth. People tend to believe they have knowledge of something when they don't. Think about a bicycle. We all know how a bicycle works. Here's a fun little experiment. Just try drawing how the chains and sprockets work between the pedals and the wheel. And as you try to draw it, you'll realize you don't actually know as much about it as you think you do before you try to make the drawing. And that's often referred to as the Dunning-Kruger effect. It's the failure to recognize our own incompetence. And this is where this high subjective knowledge, thinking we know more than we do, can be really dangerous. One study showed that people with high subjective knowledge claimed that they understood how non-existent financial products worked. So these were an experiment where they made up non-existent financial products, and yet these people high in subjective knowledge claimed that they understood exactly how they worked, even though they don't even exist. What can we do about overcoming overconfidence bias in investing? So you have to address that artificially high perception of knowledge and skills and ability without destroying people's egos, right? These people think that they can time the market, they can predict outcomes, they're likely to overtrade, they're likely to be careless and neglect risk, and they're also unwilling to take advice. How do you overcome that? One is something called the availability heuristic. So name the top 10 athletes. You might be able to do that. Now try naming a few people who have consistently timed the market and outperformed the market. Going through that exercise, people realize that's actually much more difficult than it seems. You can also try reframing positive outcomes. People make poor decisions when they're in an emotional state. Rather than try and get them to change their mind, have them think about what could go wrong. What are the possible negative outcomes? Think about the costs, making them explicit. What about tax and transaction costs and opportunity costs of another investment? As people start to think about that more rationally, they tend to be less emotional. Another great technique is to use an objective test to adjust subjective knowledge. Think of a simple 10-question test of financial literacy. And when people go through that, regardless of even knowing whether they got the answers right or wrong, it tends to reduce their subjective knowledge by almost 30%. And then try a cooling off period as well. Have people just take a day and think about it before making a decision. That can be highly effective as well in terms of reducing this overconfidence and these highly emotional decisions. Now let's talk about illusion of control. With illusion of control, there tends to be an inflated perception of the likelihood of success. People believe they have control over random events over which they're actually powerless. We tend to overestimate control when we actually have none and underestimate control when we actually do have some. And we often confuse skill and chance. When something turns out randomly in our favor, we tend to claim it's skill. When it goes against us, we tend to claim it's chance or bad luck. How does that affect investing? Well, people feel the need to regain control by taking action, any action. That's where sometimes after a market correction, even though selling at a dip may not be the best time, people just feel the need to do something. So they'll be motivated to sell, to try and do something and regain control. They're likely to take unnecessary risks, thinking that, as an example, cryptocurrency stocks, they're going up. Why not buy some? And there's never really necessary an underlying fundamental argument for it, but people like to be able to control something and make a decision. And these people are often, when suffering a large level of illusion of control, they tend to accept advice only if they feel they can see the solution. So as an advisor or someone helping people make better decisions, what can we do? One is reminding people that they have many choices. So as an example, you make the argument, you have multiple options, not just the one you're fixated on. Let's consider the pros and cons of each option. And priming self-consistency can be good as well. Remember, oftentimes there's a well-constructed portfolio, and then the investor may say, recent market events, I want to do something, anything. If you remind people that they put careful thought into their portfolio and say, you thought this was a great portfolio just a month ago, what has suddenly changed so much that you have to change everything in your portfolio? And that'll again reduce this desire to just grab control and take control regardless. Let's think about representativeness bias as another one. With representativeness bias, people tend to believe that current events mirror past events and will continue uninterrupted into the future. So we extrapolate current conditions forward in time. That ignores the possibility of unexpected, unfavorable events. Think of the market crash after COVID. No one could have predicted that. No one predicted COVID, and so no one could have predicted the market crash. And that creates negative outcomes, of course. What can we do? Well, these people with representativeness bias make short-term decisions. They're highly sensitive to momentary information, and they tend to believe that their current emotional state or circumstances will continue uninterrupted into the future. To help make better decisions, one example is engage in mental time travel. Think of the future self and describe what you're going to be doing with your portfolio in 5 years or 10 years. And that tends to get people away from the current and thinking more long-term, more goal-oriented. Another is pre-committing. So as an example, you could tell people, let's pre-commit to a number. What's your number? How much would the market have to go down before you decide to sell everything and go into cash? And, in a cold state, people will say something like 20, 30%. And that's a very extreme event. So most of the time, when you get a minor correction, then you can say, remember, we agreed the market has to go down 30% before we're going to make a big change. Finally, there's another technique called explicit emotion priming. If we acknowledge and evaluate negative emotions, get a little bit analytical about how you're thinking. Step back and say, why am I feeling this way? What is causing this anxiety? What is causing this drive? Again, that returns people to that more cold state rather than that hot state. Let's think about loss aversion bias now. With loss aversion bias, we tend to overestimate losses and tend to underestimate gains. And as an example there, think of the equity risk premium. What's the difference between what you would earn in a savings account or a risk-free account, for example, versus an equity portfolio? The amount is substantial, right? It varies from an estimate of about 3.2% to 5.58% over the last century. That's a significant risk premium. And people will often say, well, I'll leave it in the savings account. It's not going to cost me that much. But when you think about it costing between 3.2 and 5.58%, compounded over many years, people then realize exactly how much their aversion to losses in the market is actually costing them in real money from foregone gains. And when you point that out, people will see those foregone gains as a potential loss and be more willing to take risk to overcome it. So the tendency to prefer smaller rewards now over larger rewards later is known as hyperbolic discounting. And that's why people select too little risk and fail to achieve their long-term goals. As an example, the example above, for a few percent more, why take risk? But if you compound that few percent more over the long run, the risk seems much more reasonable. With loss aversion bias, there's also frequent account checking and frequent trading, and that frequent trading alone reduces returns. The more often people check the account, the more often they're driven to do something, anything, and make a trade. So another good piece of research actually showed that buy and hold investors outperformed frequent traders by 2.5% annually over the last 30 years. That's substantial. With this excessive aversion to losses, we feel the pain of losses as being twice as intense as the pleasure of gains. And that explains why people are often willing to take risk to avoid losses. And you need self-regulation to add the discipline to ignore that tendency to focus too much on short-term losses and forget about long-term gains. And many, many studies have actually shown that panic selling and insufficient returns follow almost invariably from excessive loss aversion. What can we do to overcome loss aversion? Making people aware of the outcome. So using, as an example, a small amount compounded over perhaps 25 years, you can easily see gains of between 100 and 300% just because of that compounding. When people are aware of the value of compounding to significantly magnify returns and create better returns, they're much more willing to focus less on the small amount per year. And as well, as I said earlier, framing those foregone gains as losses will trigger loss aversion. You can actually use it to people's advantage. When they see those foregone gains as a loss, they're actually more willing to take risk. Mental accounting can be another good technique. People often compartmentalize their money. And if all their money is in one account and they tend to look at it, they'll want to invest and make decisions on their entire portfolio. Think about having a small emergency account beside the portfolio. And then during periods of volatility, they tend to focus more on that small account and leave the larger, longer term bucket invested and earning with the appropriate strategy as it should. They're less willing to disturb the overall portfolio if they compartmentalize it. And as well, a really powerful technique is to discourage people from frequently checking their account. More frequent checking will increase trading desires and increase the willingness to make short-term decisions, all at the expense of long-term perspective. There was one interesting academic who said his strategy was to deliberately enter the wrong password into his online trading account 3 times so that he'd be locked out during periods of volatility, and then he wouldn't reset his password until a week or a few weeks later when the storm had passed, and then he was less likely to be influenced by those momentary decisions. Information overload is another significant factor. As financial industry experts, we often overestimate the ability of people to read, comprehend, and formulate decisions based on information. Choice overload is a great example of this. There was an experiment done where people were given a choice of 3 jams. They went into a supermarket and they could pick any one of 3 jams and they would taste it and then they'd report their satisfaction with it. Another set of people had the exact same experience, except instead of 3 jams, there were 10 jams. Now you would expect with 10 jams, you'd be much more likely to find your favorite. Let's say it's orange marmalade. In the 3 jam selection, that may not be there. It may be strawberry, raspberry, and grape. Whereas with 10, you would be more likely to find your unique most preferred choice. Interestingly, the people with 10 choices, although they might have been able to find their more preferred choice, reported less satisfaction. And the reason is they were overwhelmed by the necessary information of deciding between 10 jams. There was more opportunity for regret, and it required more mental effort. So giving them a smaller amount of information actually can make them more satisfied than giving too much information. And we tend to be guilty of this in the financial services industry. We drown our clients with information, thinking that it's going to help them make better decisions. But research shows that if you cut the information down to just what is most critical and most necessary, then it avoids that information overload. And the reason why you want to avoid information overload, it's not just decreased satisfaction with choice. The other effect is decreased motivation to choose and an increase in information search. The more information that people are presented with, the more likely they are to defer that decision and keep looking for more information until they felt that they can understand it all. Therefore, giving too much information actually has the opposite of the intended effect. What does it do? As I said, decision deferral. This is information overload, causes decision deferral. They seek additional information before deciding, and they often fail to follow through on their plans, which again will lead to suboptimal outcomes. How can we overcome this? Reduce communication to only the most important information. Cut down all of the extraneous nice-to-know information and focus just on what is most needed. What is the decision that the client needs to make at this point? As well, frame decisions as being goal-oriented. What's the desired end outcome rather than what is the information you need to look at right now? As an example, a lot of performance statements show 1, 3, 5-year returns, standard deviation, comparison to market indexes. There's beautiful charts and colors. The reality is clients are overwhelmed by that. If you could focus on here's your long-term goal and here's your progress towards it, it also gets them thinking longer term rather than thinking what happened to the market last month. And I would bet you that the vast majority of statements that you'll see out there, the biggest piece of information that is presented is what is the change in your portfolio in a day, a week, and a month. Whereas what really should be the focus is how well are you on track to achieve your 20-year target of X. We're our own worst enemies, meaning the investment industry here, by focusing so much on short term at the expense of long term. And that long-term may be there somewhere. But again, remember, information overload. There's a limited capacity to actually read through and understand all of that. And I think the other important finding that we have from research is avoid flexing, avoid demonstrating your expertise. We've actually shown that backfires. So saying to clients, don't worry about all this information. I'm an expert. I understand it. I'll make sense of it for you, and I'll tell you what you should decide. You would think that sounds like a reasonable value proposition, but the research actually shows that it has the opposite effect. People tend to trust the information less, and they tend to then defer a decision. And if you deconstruct that, you can sort of see why. By saying, don't worry about all this extra information, I'm an expert, I'll look after it for you, you're essentially saying to clients, you really don't understand any of this, but trust me, I'm going to make a decision that's in your best interest. And that naturally just elevates wariness among customers, saying, you're basically telling me that I don't know any of this and you're not going to take advantage of me and I should just trust you, and yet I don't understand anything on this statement. So you can easily see how it would create exactly the opposite outcome that we would want it to create. Let's talk now about one of the other interesting outcomes, and that's the implementation gap. So a giant analysis of 422 studies showed that intentions predict just 28% of the variance in subsequent behavior. So intention is, I'm joining a gym and I'm going to go, whereas behavior is, I went to the gym and I exercised. The challenge with financial planning and delivering advice is we oftentimes will increase intention. We say to people, you really should set up a retirement account. You really should increase the amount that you're saving. You really should avoid checking your account frequently. And people may say, okay, I agree. Yes, that's my intention. But that actually predicts a very small part of the behavior. So as an example, there was a great study done in the US with 401ks where attendees at a financial planning seminar failed to implement intended changes, and their behavior did not differ significantly from non-attendees. These are people who went to a seminar, were given all kinds of investment advice on what to do with their 401k, and they all claimed that they were going to do it and they were going to listen to the advice, and yet the amount of people that actually made decisions that were in their long-term interest didn't differ between the people who went to the seminar and the people who didn't go to the seminar and didn't hear any of that information. And the reason is that implementation gap. We try with the best of intentions to do what we should, but we often fail. How do you overcome the implementation gap? Well, one of the biggest barriers is information overload. We give people too much information to make their future decision on. There's also something called the licensing effect. And that's an interesting one where studies have been shown, for example, people who join a gym will tend to make unhealthier food choices that day afterwards because they feel they've joined the gym. They haven't actually gone to the gym, but they've joined the gym. And so as a reward, they give themselves a treat for dinner. And then a big one is procrastination. And if you can think about this with implementing a financial plan, we did research on this question exactly and found that the information overload, all of the information in the plan caused them to defer a decision and procrastinate. And then the licensing effect, simply having done a plan, made them feel like they'd done everything they needed, although they didn't actually begin implementing the plan. So what can we do to overcome that implementation gap? And this comes up far more frequently than we often realize. Every time we deliver advice to clients, there's an implementation gap. Is the client going to actually follow through and listen to the advice? So here's 5 simple techniques to overcome the implementation gap. Number 1, reduce the information overload by focusing on only the most salient aspects, the 1 or 2 things that are most important. Number 2, use pre-commitment. Get the person to agree to an implementation plan before engaging in planning. That implementation plan is, I will do this by this date, and get them to agree to that before even doing the plan. Otherwise, the planning is useless. Number 3, goal framing. Focus on the distant goals. What is it you're trying to achieve over 10 or 15 or 20 years? Reinforce self-efficacy. Remind people that if they stick to the plan, they will achieve it. They're capable of it. Give performance feedback. So in the earlier example I was giving on statements, show that long-term goal and show percentage of achievement every single time you talk to a client, rather than how much did your portfolio go up and down last week. Explicitly recognize that licensing effect. That's suggestion number 4. Give the story of going to a gym and remind people that just planning is not actually enough. You actually have to do as well. And finally, overcome that procrastination by using implementation intentions. Have people write out a plan for what they're going to do and how they're going to do it, and then they will overcome the implementation gap. I hope some of this has been really helpful. I'm going to have an opportunity. All right, we have some time for questions. I've got a bunch that were provided to me, and I will try and answer as many as possible in approximately the next 15 minutes. One of the questions is, do you think this is a cultural challenge? Do investors in Mexico have the same biases as in other countries like Canada or the USA? It's an interesting question. A lot of our research actually shows that the differences culturally are surprisingly unaffected by the behavioral biases. People tend to be risk averse regardless of what country they live in. They can suffer from overconfidence regardless of the country they live in. And if you look at those differences in those biases, they're really non-significant. They're very tiny, like on the order of a couple of percentage points. And that's been validated in lots of other research. So, for example, Hofstede, who's done research on cultures and different cultures across many, many different countries. There's a similar finding there in that we have a lot of underlying biases that are consistent regardless of the culture. Think of loss aversion. No one likes losing. Or risk aversion. People don't like risk, and they tend to behave very similarly. So a lot of those biases like overconfidence, illusion of control, representativeness, the implementation gap, those operate across cultures and across countries. And so those tactics that I suggested are going to be quite effective regardless of which culture or which country you're operating in. The next question is, how can we discourage investors from constantly checking their balance accounts in such uncertain times? That's a temptation. People really, particularly when they're nervous and particularly when markets are declining, they tend to check more frequently. I think the best way to counter that is to remind people of the long term, that there's a long-term focus, and also remind people that checking the account or your balances frequently actually increases anxiety more than decreases it. And due to that, illusion of control, it tends to make us make poor decisions. I gave the example of the behavioral economist who deliberately entered his password incorrectly. That's extreme. I think the best way to deal with it is to have a conversation with people about why they check their account balance and what they do as a result of it. And it's called metacognition, which is thinking about thinking. If you can get people out of the emotional space and into the more rational space, we can recognize those biases in ourselves. We all know that we have bad habits. We also have bad thinking habits. And we can be aware of those. And once we become aware of them, we're actually more likely to be able to prevent them from causing suboptimal behaviors. Next question is, do you have an example of using implementation intentions to reduce procrastination? There was a great study done on voting. Surprisingly fewer people vote than should vote. And if you look at the reasons why sometimes people don't vote, we have the best of intentions and we say, yes, I'm definitely going to vote. In this particular study, what they had was they called people and said, do you intend to vote in the next election? And people would say yes. And then they said, well, what's your plan? And the respondents would say, well, what do you mean? And they said, well, what time are you going to vote? At what time will you do it? And then people would think, and they'd say, okay, well, maybe 5 o'clock. When do you know where to vote? Well, no, I haven't looked that up yet. Well, why don't you look it up right now and find out exactly where it is? And then how are you going to get there? Oh, well, I think I'll drive, or,
I think I'll take transit. And so when people actually form a plan and decide how they're going to do something, that is an implementation intention. And that in itself can reduce procrastination. And again, what it is causing people to consciously formulate a plan for what they're going to do and how they're going to do it. And if you think about a plan with respect to savings goals or reducing debt or um, increasing asset allocation to certain asset classes, the more specific you can have people in, and it doesn't help to hand it to them. What you have to do is have people come up with the plan themselves. And the process of working through the plan is often, I think it was Confucius who said the longest journey begins with the first step. Getting people to consciously think about how they're going to do something and how they're going to accomplish it oftentimes then makes it less intimidating for those people when they go to do it because they've already thought about which way they're going to do it. The next question is, with COVID and inflation making markets volatile, never mind geopolitical uncertainty, with COVID and inflation making markets volatile, what is your best advice to navigate this financial turmoil? I think the best advice there is to keep a long-term perspective. You can go back and look at the COVID crash in March of 2019. I believe it went down 34%, and it was back up 17% or so within the first 3 days. And within about a month and a half, it was, above where it had been before that. And the people who panicked and pulled money out of the market, they were the ones that were harmed. The lucky people were the people who didn't even look at the market, didn't know that it had crashed, didn't know how much it had crashed, and it went down and up and they never knew it. So they never suffered the anxiety of the decline and never had an opportunity to pull their money out of the market and permanently lose 34%. So I think the best advice is to get people to focus beyond short term. And whether that's weeks or months or even a year, focus on the long term. And think about what I said with information overload. You can overload and deluge people with information, but sometimes a very, very simple picture can tell a lot. Take a look at the S&P 500 over a 25-year time period, and look at those momentary blips that. When you look over a 25-year time frame, it's just a tick. If you were to zoom in, for example, on March 2019, the COVID crash, and just look at that week, it would look like a massive change. When you zoom out and look at it over 25 years, you realize it's just part of the normal ongoing fluctuations. I don't have the statistics right on the top of my mind right now, but look at time periods and look at the S&P 500. I recall some research that showed that if you look at 5-year blocks, it's very, very difficult to find any 5-year time period where you would have been disadvantaged by being fully invested versus alternatives. So as long as your time frame is long enough, then financial turmoil really, the momentary financial turmoil really doesn't matter. What is your firm doing to solve this challenge? Well, this is an example of one of the things that we're doing to solve this challenge. I do speaking like this regularly and talk about why it is that people make these decisions which seem to be non-rational. Like, why would you sell your entire portfolio after a 34% decline and sit on the sidelines and lock in a 34% loss? And so just talking about it and breaking it down and explaining that it's our non-rational emotional reaction to information and the biases that we have that are very difficult to avoid. That's what really is the biggest challenge. And so me talking about behavioral economics and what the insights of behavioral science are into how we make financial decisions, the more aware we are of it, both as advisors as well as investors. So, for example, advisors becoming aware of the fact that they can be, excessively present biased. That then helps them as well engage in metacognition. So the short answer, what is our firm doing about this challenge? We're raising awareness of the impact of those psychological, emotional, social, contextual factors behavioral biases and how they affect decision making. The more we study it and the more we talk about it, the more we are able to actually prevent the negative effects of it. Another question, is there a book you recommend to learn more about it? I think a great book would be Predictably Irrational by Dan Ariely. Dan Ariely is one of the founders of BEWorks. He's also a recognized leader in behavioral economics. He teaches at Duke. He's a very approachable author. His books are very interesting. It's a very easy read. It's a weekend read. This isn't a finance textbook. It's full of interesting, humorous anecdotes, but it also does a really good job of explaining what behavioral biases are and how they impact us and how we can take steps to avoid the negative impact. Okay, what's the next one? Do broker-dealers have this information in their hands? BEWorks has developed a training program called Behavioral Economics for Advisors, and we actually published a study as well. You can find more information on the BEWorks website. But the study was the value of behaviorally informed advice. And what it did was show and prove that there's better outcomes for investors if advisors incorporate the insights of behavioral science into the delivery of advice. And so we've trained thousands of financial advisors now on what behavioral biases are, how they affect investment decision making. And a lot of the material in there is similar to what I was speaking earlier. We talk about biases, for example, overconfidence. Well, what is it? How does it work? What is the impact on investors? And how can we overcome it? And just having brokers aware of behavioral biases allows them to engage in metacognition so that they can then think about, oh, how am I being overconfident right now? Am I suffering from illusion of control? Am I suffering from representativeness bias? Am I thinking about this emotionally or am I thinking about this rationally? So the training for financial advisors can be very helpful for them. And that's one of the things that no one's immune from behavioral biases. Everyone has them. But when we're aware of them and when we recognize them and when we think actively to take steps to avoid having the negative impacts, then there's really better outcomes. Another question here is about two thinking systems. Surely financial decisions are related to rational thinking, right? It is kind of funny. You would think when you're talking about money that we'd switch on that computer part of our brain, that, the purely logical. Think of Spock, right? We become Spock when it's investment decision making. Well, in fact, there's countless examples where we don't do that. I can think of examples of people who compartmentalize their money, and they have, as an example, they'll keep money in a savings account and they'll also have debt on their credit card, and that's not rational at all. Why you do that? Why you'd earn a quarter of a point if you're lucky on a savings account and pay 20% on your balance on your credit card? But people do it because they want to think that they have money. And as soon as if they take their money out of their savings account and pay it down to zero and pay off their credit card, economically they're ahead, but they suddenly feel poor. They feel like they have no money. And so definitely not. Financial decisions are not purely rational. In fact, they're no more rational than any other decisions. We don't have the luxury of being able to switch our brain and become Spock when it's necessary. What we can do, though, is recognize that happens, that we don't always think rationally, and that's where sometimes it's helpful to take a step back and engage in metacognition and say, am I really making the right decision here based on a purely rational, analytical, consistent, utility maximizing decision criteria? And if you think about it that way, you realize many of our decisions aren't. And although you would hope that financial decisions are always rational, in fact, they're not. Those are the questions. So I hope it's been helpful and interesting. If you'd like more information on some of this, by all means, visit the BEWorks website, and you'll find lots of interesting research and lots of interesting studies and findings. You can also find more references for other places where you can gather more information. Thanks very much. I hope you've enjoyed it. It's been a pleasure.